Hello everyone, hope you're all doing well and welcome back to the Baking Analyst channel. On this channel, we cover everything from cryptocurrencies to economics to personal finance with a focus on decentralized finance or DeFi. Previously on DeFi, we have basically focused on making use of yield farming protocols in order to generate crypto passive income, and in coming videos, we will also be looking at how you can get into this DeFi space full-time and also looking at new ways of looking at risk management in DeFi investing. So if all that sounds interesting to you, do consider leaving a like and subscribing to this channel. Today, we're going to be talking about a mid-bear market portfolio update. We haven't done one of these in quite a long time, especially as the market has taken a dump and it wasn't really wise to tell people exactly what kind of things you were doing in case that turned out to be a rug. And you know what? Some of them did turn out to be rugs. For example, Kronos DAO, as you can still see on my bookmarks over here, that turned out to be a rug, and also ValueSwap, which was actually rugged by Evo DeFi. So now that the overall space has stabilized a bit at around 20 to 24K as for the Bitcoin price, and as we're also seeing this kind of slowdown in black swan events and catastrophic failures happening in crypto, I thought it would be a good idea to start looking at restarting yield farming operations, since the crux of yield farming is, as I always said, compound interest over the long term. Now, in this case, I would still say that a lot of these inflationary altcoins, such as MMF, for instance, might still be a risky play, even though the Polygon side of it, which we'll be talking about in a bit, does have that sort of early advantage, meaning that if you were to get in early, you might have made a 4 to 5x, as we've seen in people who have participated in the launchpad. So while interest in crypto in general is still at a relatively low level, what am I doing to position myself in this market? Today, let's take a bit of a look into that. Now, before I start, I wanted to just mention that you can always join our Discord server where you can ask any sorts of questions. There is a community of yield farmers and DeFi natives in there. If you're completely new to the world of decentralized finance, I also have an introductory Skillshare course. You can access that using a Skillshare plan, and you can cancel it at any time, and it'll come at little cost to you, or even no cost to you whatsoever, as long as you cancel it within the free trial period. So with that shilling out of the way, let's jump right into today's content. Today, I'll be talking about what I am doing about this whole yield farming thing, especially after having taken a break for some weeks and months. So one of the biggest news items that happened in recent weeks was that MMF, or Matt Meerkat Finance team, they just launched on Polygon, and once again, this is a team that has been around for a while. They have built on Kronos chain. They have in fact been exploited a few times, both on their trading platform as well as on their NFT front, and they have compensated users both times. So this in general is what I would class as a relatively low risk project in terms of smart contracts and rug risk, because these developers are willing to actually compensate their investors and make sure that, you know, people are remaining confident in this whole platform. So of course, that is something that we have going for the Matt Meerkat Finance ecosystem. Even though their governance token has basically tanked, I don't expect this to go up to the all-time highs anytime soon, especially because token supply has inflated so much over the past few months, and at the same time we're also seeing lowered interest and increased interest rather in their new developments as opposed to those on Kronos. So let's have a look at the new MMF platform on Polygon network. And the thing I like about this is that you don't necessarily need to stake your tokens in the native pools, especially if you're not comfortable with taking the kind of risks that are associated with 90% dumps in the bear market, especially for a low cap token like MMF. Of course, you can make a speculative play, and I do still have my speculative position open over on the Kronos chain with the MAD platform. So what I wanted to highlight in this video were actually these opportunities down here. When you scroll past these two native pools, we see that we have some really juicy pools down here. We have our Matic USDC and our Bitcoin USDC, as well as our ETH USDC pools that you might want to consider investing in. Now, all of these pools are of course consisting of blue chips, USDC, Matic, Bitcoin, and Ethereum. Those are all top projects. And I've basically shifted funds into the Matic USDT pool because that was paying close to 80% APR. Now that, while not as high as before, is dangerously close to what we saw while we were still in that bull market and that DeFi summer that we saw earlier on in the year. So this was something that was a very welcome reprieve, especially in this era of low returns. We do see competitive returns on Bitcoin and Ethereum as well at 45% and 49%. And you know, I do have a position over here on MMF, and that is in the BTC USDC pool that they actually recently opened up. And we see over here that this BTC USDC pool is paying out 27%. So by comparison, 45% to 49% is very competitive. And as for why these APRs are still relatively high and haven't been diluted, well, first of all, there is already quite a bit of liquidity in this pool, meaning that the dilution has kind of already happened. This high APR is a function of the high governance token price. The other reason why the APRs might be as high as such are that generally now there is a hesitancy towards investing in crypto, especially after the high-profile failures like Celsius and 3 Hours Capital. People are generally still very, very bearish, very, very fearful. And as a result, if there are less people to dilute your APRs, this is a time that you want to be redeploying. So that is the general strategy that I'm approaching this with, dollar cost averaging into all of these blue chip pools. Now, of course, I'm doing this slowly over time and whittling down my stablecoin position, which is on yet another highly established protocol. This is, of course, Tomb Finance, or rather Tomb.com, the original Tomb that everyone seems to be forking these days. Anyway, they have a USDC, USDT pool that I have locked some money into and basically earning some relatively low rewards before I start moving them to dollar cost average over time into Bitcoin and Ethereum, so all these main projects. So of course, now is not really the time, in my opinion, to be trying to speculate with large positions on crazy altcoins, although some small position that is right-sized in relation to your overall portfolio might make sense. If you want slightly higher risk in terms of stablecoins and at a slightly higher APR return, Tomb is also offering a USDC MIM pool around 17%, which is close to that of the ill-fated UST. So make what you want of that. It is still an opportunity that is out there to be taken if you have the appetite for it. Finally, I wanted to talk a bit about why I think that moving to Polygon is likely a good idea, and that is because of the capitalization of the chain. Now, as you all know, one of the risks of any sort of layer 1 protocol and what can cause it to fail is the fact that it is uncapitalized, making it impossible for people to redeem their wrapped tokens one for one in case one of the bridges or one of the protocols connecting to that chain were to fail. We saw this with Oasis, with the Evo DeFi bridge. We saw this with Harmony One, with the Harmony One bridge. And so one thing good about Polygon is that they actually have Polygon USDC support directly from Circle, meaning that you can transact with Circle, which is the issuer of USDC, and basically get your US dollars back one for one if you have USDC on Polygon itself. The difference in this case is that for Polygon, you are redeeming your USDC directly from the issuer as opposed to a centralized exchange that can just say no. If you want to see my own criteria for ranking L1s, you can watch my previous video in which I talked about which L1s I'm stacking, as well as the video on what could possibly happen if Crypto.com were to pull a Celsius. Basically, what will happen to Chronos if something like the Harmony One bridge hack were to happen. So I'm actually working on a L1 capital analysis tool. Basically, this allows people to check and analyze what would potentially happen if one of the bridges were to fail on any of their favorite L1 networks, and how much exit liquidity there is in relation to overall TVL. Not going to go into depth about how this entire spreadsheet works. Essentially, it pulls on-chain data using various APIs and basically calculates the ratio of available bridge exit liquidity to overall TVL in the ecosystem. So anything over 1.0 is technically good, and anytime where stress capitalization, which is a scenario where the major bridge has failed, if that is over 1.0, that is considered as a good result. So as you can see from here, Polygon, because it's directly redeemable, we have a score of 1.0, which is good, and it is also relatively well capitalized. Of course, this whole tool is very much work in progress. The endpoint of this tool is to allow people to obtain quick DeFi ratings, so do look forward to that in future videos as a new product from this channel. So all in all, I hope you found this video interesting and informative. If you like this video, do leave a like down below. If you have any comments, happy to see your comments in the description down below as well. And with that being said, thanks for watching, and I will see you in the next one.